creating wealth, freedom, and security using real estate investing. This is Get Real Wealthy. We're going to be going through why I think multifamily apartments are better. Let's first talk about the differences between apartments. A 1 to 4 unit apartment is what I would consider residential. 5+ units, I would call them commercial or multifamily. In the residential game, you usually have financing that's different based on the number of units that you have. Now, sometimes you can find a financial institution like RBC, for example, that will finance maybe 5 units or 6 units perhaps in a building on a residential pro forma. But typically, when you're looking at commercial or multifamily apartments, you're looking at 5 or more units. Now, that's the difference with the actual unit count, but there's a lot difference when it comes to how you can work with this asset class. So when you're doing financing on a multi-unit building, you'll find out that the way that your appraisal gets done is different on a 1 to 4 unit property than it is on a multifamily property. In a 1 to 4 unit property, you have what's called a comparative method. That comparative method for appraisal means that the property across the street, if it's same or very similar to your property and it sold for $900,000, your property is worth $900,000. If 2 weeks later it sold for $850,000, your property is now worth $850,000. That's the comparative method. Now, barring any variations in the type of property, it's going to be pretty consistent to that. Now, for a multifamily property, it's based on the income method. The net operating income of your property is going to define the value of the property. And the type of financing that you're going to get on that property is going to be based on the debt coverage ratio, how much debt that you have based on the expenses and then the income that's coming in. If your debt coverage ratio is 1.2, it means that you're getting 20% more income than all the debt that's in that asset. Okay. Now, what happens for financing for rental properties is usually that the property is going to be the amount of equity that you can release in a property is going to be based on what the rents are, also what your income is, and that's going to allow you to release some equity in the property. But they're probably not going to allow you to take out more equity than what you're making in income. And that's often the problem with 1 to 4 unit properties. You get a lot of trapped equity. Now, in an apartment building, because it's based on the net operating income, oftentimes you can release that equity a lot easier in a multifamily building. So one of the reasons why I like the multifamily space is the ability to use debt coverage ratio and net operating income to be able to release equity and take that equity and reinvest that into more buildings. The other thing that I like about multifamily is that it's a small group of people. People know each other. It takes a while to develop the relationships that allow you to invest in those properties because there aren't that many buildings. In Ontario, there may be like between 20 and 100 units. Maybe there's 5,800 buildings altogether. That is not a lot of buildings. People may be shocked by those numbers. And that's why it's very challenging to be able to find buildings that make sense. That's a lack of supply, and also there's so much government red tape and bureaucracy around building these properties. The likelihood that we're going to see a large supply come on the market is very unlikely. Although the federal and provincial governments are pushing this, the municipal governments are working in a different direction. And I say that with like all honesty, I believe that it is not going to work because of the municipal approach to things. Now, maybe that could change in the future, but until then, we're going to have a supply problem with apartment buildings. I know that lack of supply maybe is not a good thing, but it's a good thing if you own those buildings, and it's a good thing if you be able to have the deal flow and the relationships that are able you to access those buildings. Now, the third thing, CMHC mortgages. It's probably something that's not really talked about. Usually you hear more about conventional mortgages, but CMHC has terms that allow you to have 35-year amortizations, 40-year amortizations, 30-year amortizations. That amortization allows you to lower your monthly cost and allow you to qualify for more of the mortgage. Sometimes you can get up to 85% loan to value. We recently did an 85% 40-year term on an existing building. So it's possible to be able to do that with CMHC, whereas with investment properties, oftentimes it's much more difficult to get higher amortizations and higher loan to values. Another benefit of buildings is that there's a lot of demographic growth that's driving demand, and a lot of times we find out that people are coming to Ontario. So for example, last year, 2021, 410,000 people came to Canada. A majority of those people would have come to Ontario, and a majority of those would have come to the GTA. Those people who are in the GTA, usually they're going to be looking for places to stay. When you're an immigrant to the country, usually you rent for the first few years. So those renters are going to push up demand of rental units. I know that as the population continues to grow, that I will have a population that will continue to need my rental units, including those who are moving out from their homes, kids that are moving away from their homes and on their own. So there's that demographic as well. Another thing that I like about apartment buildings is oftentimes you're buying them for lower than the replacement cost. Not everybody really understands how much it costs to build apartment buildings. Even though our cap rates are lower, usually we're buying properties less than the replacement cost. The cost of actually rebuilding that building is going to cost more than what we're purchasing the building for. And oftentimes people don't even see that. So there is a real benefit to being able to do that. Another benefit I want to say is the repositioning the asset. We do the BRRRR strategy on apartment buildings: buy, reposition, refinance, and then continue to rent. And then on the refinance, we are paying back our investors, usually their initial investment. That's in year 3 to 5. And they continue to own the asset. We don't exit partners and just continue to grow. So that's one of the things that I really like about this particular building, or buildings in general, because when we do that refinance, there's the capital repayment to the investors. That capital repayment allows us to actually give them their funds back, which they often will invest in the next project. So it's something that I really like. In the next reason, I'll show you why that's powerful. So, for example, let's say we have a property in Oshawa, and CMHC uses a cap rate of 4, but the property is actually a cap rate of 3, the market cap rate. Well, how do you figure out cap rate? Well, let's say, first of all, if I'm buying buildings, the rent is at $900, but the market rent is, let's say, $1,600. What happens when I re-rent the unit is that I actually gain that value in my net operating income, because my income has gone up $700. Take out a calculator, do 700 multiplied by 12, because it's net operating income for the year. 700 times 12. Now divide that by the cap rate. Let's use 0.4. That one unit that went up $700 a month, that's the value that happens in that building just by that one rent turnover. That's the power of the apartment building. And that's for a value add or a repositioning project. The next one, cap rates are affected by three factors. They're affected by the location of the asset, they're affected by interest rates, and they're affected by the condition of the building. Like if it's a newer building or an older building, that's going to affect the cap rate. And oftentimes cap rates are naturally compressing over time. They're coming down. Historically, if you look at cap rates from the 60s, 70s, 80s, 90s, you can see cap rates are compressing. And it's very interesting to see, and it's something that you want to be able to take advantage of as a real estate owner and an apartment building owner. So anyways, I've got a bunch more reasons, but I don't want to take you away from whatever you're doing. If you want to reach out to me and talk more about investing in multifamily buildings and why I think it's awesome, you can reach out to me at QManREI or at Quentin at getrealwealthy.com. Until next episode, take a look at your portfolio, see if you want to invest in multifamily apartment buildings, and remember, get real wealthy. See you on the next episode.
Make sure to check out getrealwealthy.com.
Until next time, I'm Quentin D'Souza. Get out there and take action.
The views and opinions expressed in this podcast are provided for information purposes only and should not be construed as an offer to buy or sell any securities or to make or consider any investment or course of action. For more information, go to getrealwealthy.com.